Hey everybody, good to be here today. It's Wednesday. It means it's Managing an Options Portfolio Day. My name is Brent Moores. We do this each week, and so we'll get to a bunch of different trades, looking at different types of trades, talking about managing those trades in just a little bit. Let me just mention a few things first, though. One, I'm in here with Connie Hill. Connie's helping me out in the chat. Appreciate Connie always. And so as you have questions, feel free to type those in the chat between Connie and myself. We'll do our best to get to your questions. And well, appreciate you. You know, I see some names in the chat, some familiar names, some not as familiar. Glad for all of you. Happy for all of you. And if you're watching on a recording, that's great too. Glad you're here. Let's go through a few disclosures before we get too far into this, though. Options do carry a high level of risk and are not suitable for all investors. And multi-leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. That's different than the paper money application, because paper money doesn't assign short options early, but in real life, short options can get assigned early, and we are going to talk about short options today, so that's important. Rolling strategies can entail additional transaction costs. The material today is intended for general, informational, and educational purposes only. And paper money virtual trading application is for educational purposes only. It won't assign short options early. I mentioned that earlier. For the sake of simplicity, our examples aren't going to factor in commissions, but it is something to consider, right? Something important. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risks, including loss of principal, and past performance. There's no guarantee of future results. Here's the markets. It's roughly flat today, is what we'll say. We opened up this morning higher. We had a positive jobs report, and seemed to the market kind of marched up, and then it's just reversed, and we're back down to pretty close to where we started here. So that's the S&P 500. But what I want to talk about today is I want to talk about eventually we're going to get to the wheel strategy, what's called the wheel strategy. Some of you may not be familiar with that term. You may be familiar with the strategy, even if you're not familiar with the term. That was me for many years. It wasn't a term I used, but it's something I considered and looked at and even taught without using that term. But we're going to get to that. But I just want to talk about, to start, just short puts, okay? Because short puts are just a way of entering a trade, potentially. Well, it's short puts are a strategy in themselves, but they're also a means to enter another trade. And I'll explain that in just one sec. But after we go through this, then I want to look at different options positions that we do each week in this webcast. This is managing an options portfolio. But for example, I'm going to use the stock NVIDIA. Okay, so here's NVIDIA. A lot of you, I think probably most of you, are familiar with NVIDIA. NVIDIA, for the most part, has been kind of going more or less sideways-ish for a little while. But it can certainly move. And if we look at NVIDIA, if I pull up NVIDIA, you can see implied volatilities are a little bit kind of higher compared to a lot of stocks. Something in the 40% range, 50% range. We have earnings before too long, and that's okay. But as we look at this chart, first thing to know on a short put is we need to be bullish. We're bullish on this. We're bringing in a premium. We're bringing in money as a credit in agreement to buy a stock. So if we say on NVIDIA, I'm willing to buy NVIDIA if, hey, look, we got this, maybe it's kind of what we'd consider kind of a resistance level-ish up here, maybe kind of a support level down here. If it kind of drops towards the bottom range there, maybe we're willing to buy it with the thought that it's a little cheaper. There's a good chance it doesn't go down there. Either way, we get to keep the premium. That's great. But if it does drop down, we're agreeing to buy the stock down at one of these lower levels. Maybe that's not so bad either, because we're buying it if we'll just say the 180 level. Okay, say we buy at the 180 level. Well, right now it's at 190. So that's a little cheaper. We're agreeing to buy 100 shares of this. That's that's what our purpose is here on this. And so let's go to NVIDIA. Let's look over here, and we're going to decide how far out are we going to go. Notice there's a lot of strikes on NVIDIA. NVIDIA is one of those stocks. There's just a few, Mag 7 and a couple others, where they've added new expiration dates. So not only do we have the weekly expiration dates, like in 2 days and 7 days, we have weeklies at, that are 2 days apart from each other. Okay, so we have like Wednesday expiration stuff. But I'm going to go out further than that. And for these, what I'm going to be doing is I'm going to be looking to sell at a time when theta is higher. Theta is the rate of time decay. That benefits us as a short option holder. And generally, just as a rough guide, thetas really start to increase with about a month to go to expiration. They continue to get higher as you get closer to expiration. So just as a default here, I'm going to go out about 30 days. I'm going to go out about 30 days here. Maybe a little less. We can increase that theta. But when we're initially looking this is just going to be my default look out about 30 days. But maybe you decide 14 days is more appropriate, or some other time frame is more appropriate. You can do that. And that partially may be dictated by the chart. Maybe you're trying to avoid earnings. I don't think you need to, but if earnings is on the 25th, it looks like it's kind of flashing on me about the 25th, then maybe I want to sell before the 25th. I'm not going to do that though. I'm just going to go out here and I'm going to say, maybe we go out a month, maybe a little less. Sometimes the expiration date you choose may depend on whether it's a monthly contract, these ones that are just in white, or the ones that say weekly next to them, because often the ones that say weeklies next to them don't have as much liquidity. But NVIDIA is an uber liquid stock. I mean, we're at 81 million shares traded on the stock today. So that's probably not a problem. Let's go out to March 6th, okay? And you can just kind of look at the difference between the bid price and the ask price on these. And I'm going to look to sell something around a 30 delta. Delta tells us how much that option is going to move in relationship to a $1 move in the stock price, but it also gives us an approximation at least. It gives us an approximation of the probability of it ending up in the money. So a 29 delta is going to have somewhere in the range, roughly, a 29% chance of ending up in the money. It's not the end of the world, because what we're going to say here, we're only going to do this on stocks that we're bullish on in the first place, that we think it may be not a bad buy if the stock goes down to 180 and buying it at 180. But here's the thing. We could just put in an order to buy at 180. We could put in a limit order to buy this stock if it's, if the stock goes down to 180. But in this case, we're getting paid a premium, $465 to do this trade, approximately. Okay, $465 to do this trade. Question in the chat: why do I pick somewhere around the 30 delta? And again, there's no hard and fast rules here. I'm trying to balance the probabilities of it being in the money with the amount of premium. Like ideally, I'd go to something where, hey, I'm not going to end up, I don't have any obligation to buy the stock. Maybe something with a very low delta. But if I do that, my premiums are very low. This would be $85 instead of $460. Okay. Look, I can get more premiums here if I go to a higher delta, but I'm also much more likely I'm going to buy the stock. In this case, I'm going to just kind of say, there's a good chance I'm not going to buy the stock. I'm going to keep that odds down to about 30%, but I want to bring in that premium there. Okay, so good question. I certainly could do something closer to the 15 delta. Really, I want to bring in more premium here, though. And I'm not trying to avoid buying the stock. We'll get to that in a minute, because this part of this strategy, this overall strategy, which we haven't got to yet, but part of the overall strategy is we can buying the stock's not a bad thing. Okay. And you'll see why in just a minute. All right. Let's go there. Okay. So let's look at this. I'm going to sell this stock. I'm going to sell this put, excuse me. I'm going to go to the 180. Make sure that price, even though I looked at the delta here, make sure it makes sense for you on the chart. Does 180 make sense? Does that seem like a reasonable level from a technical standpoint? If it does, then that may confirm the choice we're doing here. Okay. We're just doing a short put here. We're just doing a single short put. I'm going to click on the bid price. Click on the bid price. It loads up a trade. Make sure you know your quantity. Mine's -1, but depending on what your default is, it could be something different. This is obligating me to buy 100 shares of stock. Okay. If that's too much for you, then you wouldn't do this strategy. 100 shares of a $191 stock, that's $19,000. Some people's portfolios, that wouldn't make sense. $180 is our buy price, so $18,000 worth of stock. Okay, $18,000 of stock. Could you do this with a lower price stock? Yeah, you can do this with a lower price stock if NVIDIA is too expensive there. Okay, so let's go, and I'm just going to confirm and send, and I'm going to throw this in my short puts bucket there, and we're going to sell this, and I'm going to send this. Okay, so now we have that NVIDIA stock. Now, let's talk about this. One of the great things about this is we're saying, look, if the stock doesn't go down, I mean, technically, it can be assigned even if it's out of the money, but most likely it's not going to. But if the stock stays up here, that $460 credit, we just get to keep. The option would expire eventually, and we could do the same thing again. Maybe in another, I think it was 3-week expiration. Maybe the stock's up at 200 at that point. Maybe at that point we sell a 185 or 190 put. Okay. If the stock stays above that, and given our probabilities, there's about a 70% chance it's going to stay above that, we could turn around and sell that put again and bring in more premium. Okay. Not bad. What if the stock goes down? Let's say NVIDIA goes down like this. Okay. NVIDIA goes like this, and NVIDIA is down here. Okay. We'll say 175. We end up buying the stock for 180. Okay. So we end up with 100 shares of NVIDIA stock. Okay. And that's, maybe it's not such a terrible thing because we brought in $465. We're in the hole on the stock because the stock's down at 175, but we bought it at 180, but we also brought in $465 or $460 worth of premium on the side. Okay. So not terrible, but then we own the stock. Okay. Then we own the stock. What are we going to do when we own 100 shares of stock at, we'll just say 180 here? Well, one thing is we could just hold on to the stock, hope it goes up. That's great. But another thing we could do is we can do a similar strategy to the short put we just did. And that is we could sell a call. Let's just say we sell a call at 190 at that point. Okay. What's going to happen? We own the stock. We bought the stock at 180. We sell a call at 190. I'm just going to make up an amount. I don't know exactly what the premium would be, but let's just say we bring in a $4 premium or $400 worth of credit there. If the stock happens to go back up above 190, what's happened? We sell the stock at 190. Well, initially we bought it at 180. Here we're saying we're going to sell it at 190. We're bringing in another $400 in addition to the $460 we brought in on the short put. So all in all, we made $1,000 on the stock in this scenario. Plus we made $400 in premium plus $460 in premium plus $860. I'm not factoring in commissions here in additional premiums. Now, I just gave you a good scenario, okay? There's bad scenarios too. We're going to talk about those because I don't want to give you a one-sided picture. I want to give you the full picture here. But this is what we call the wheel strategy. Let me just kind of be clear on what the wheel strategy is. You sell a put, okay? If you don't buy the stock because of the short put, you can sell the put again. But what the wheel strategy is, you sell a put, you buy the stock, you sell a call, a covered call, you bring in premium on each of these, and then you lose the stock. You sell the stock because of the covered call. Then what do? You can sell another put. And then if you buy that stock and it happens to go up above the stock, above your new covered call, then you sell the stock at the higher price. Each way along the way, there's a little premium you're bringing in, little premium you're bringing in, little premium. And so that's the ideal situation. Okay? Now, we're going to talk about a not ideal situation here. But before I do that, let me just mention this. There's a survey link in the chat. We appreciate your feedback, everybody. If you would just click on that link, give us some feedback. It's a short survey. Believe me, I don't like long surveys. This one's not a long survey. But feel free, type in the chat there or click on that link and give us some feedback. Okay. So let's say we do this. We sell the 180 put, which we just did. And what if the stock goes down? Okay. Well, that's the plan. And we end up buying the stock for 180. And then what we do is we sell that covered call. Let's say we sell that covered call up here, but the stock keeps going down and down and down, okay? Well, we brought in that initial premium. We bought the stock for 180. We brought in another premium on that covered call, but the stock can drop a lot more than the premium on the new covered call. Well, eventually we look up and the stock's at, we'll say 160. What are we going to do then? Do we sell another call? Yeah, we can sell another call, but to get any sort of premium on that call, maybe we're selling it at the 165 price or the 170 price. And then if the stock goes up, we end up selling out at the 165 price. You can get in a hole, in other words. This strategy is not perfect. It's not a guarantee. And if the stock goes down and down and down, then you're going to end up losing money. Okay, so there we go. Okay, now, let's see. So we talked about the good scenario. We talked about the bad scenario. So the thing we want to avoid is a stock that we think is going to go down a whole lot. I don't know. You never know for sure, but you do those things that you think are going to be stocks that aren't going to be going down. Maybe you're looking at technical analysis, looking at trend, looking at support and resistance levels. Maybe you're looking at fundamentals even, if you're looking for something a little bit longer term, something that where you think the company is going to perform well over time. Now, some companies are a little more volatile. NVIDIA tends to be a little bit more of a volatile company. Yeah, it is. And you get higher premiums because implied volatilities are higher, and you get higher premiums on both your calls and puts when you have higher implied volatilities. All right? So there we go. Hopefully that's making sense there. Okay, let's address some questions, and Connie's helping me out on the questions, and then I want to move on to the next thing. Let's see. If the stock goes before the short put gets exercised, if stock goes before the short puts gets exercised, would you consider rolling to lower strike? Okay, so this is the scenario that Josh is asking about, which is a good question. We sold a put at 180. What if the stock goes down? We still have a bunch of time. It hasn't been assigned at this point. Okay. Would you consider rolling that put down? You certainly can. A lot of people don't do that. Will do that, but I don't think it's necessary. And the reason is in this strategy, there's not a problem. Our intention is to ultimately buy the stock anyway. So yes, you can roll it down, but very often people will say, well, I'm going to roll it, but if I can roll it for a credit or something like that, that's okay. So I can go either way on that one, Josh. I don't think there's a definitive way of doing it, but if the stock goes down, you can roll that down. And for those of you who aren't familiar, what I mean by rolling down is this, is we sold a put at 180. If this starts to go in a hole, maybe we sell either the same date or perhaps even a later date. Maybe we go to March 13th or something at a lower strike. So we're obligating ourselves to buy it at the stock at a lower strike than the 180 price. You can do that, but it could cost you. Okay, it could cost you. Especially, it's going to cost you if you don't roll out to a longer date there on this. If at any point you just turn plain bearish on the stock, this is not the strategy for you. This is a bullish strategy. Why? If you do a short put, what's your delta on a short put? Short put? Well, if we sell at a 30 delta, your delta is about minus 0.3 or minus 30. Okay, that's a short put. What about on a covered call? What's your, sorry, you're not minus 0.3, it's plus 0.3, it's positive 30 because it's a put, which is negative, but we're selling it, so it makes it a positive 0.3. What about on a covered call? Well, we own 100 shares of stock, that's 100 delta, okay? And then we're selling a call, which would be, say, minus 30 delta or something like that. And so you end up with a positive, probably something in the range order of 70 delta. Either way, any way where we're in this strategy, this is a positive bullish trade. If we turn bearish on NVIDIA and just think it's going to go down, you just got to get out. There are other trades, in fact, we'll look at today. There's other strategies that it doesn't matter the strategy. Sometimes you get in a hole and you got to take your lumps, man. You just got to get out if it's going against you far enough and if your forecast has changed on that. Okay? So this strategy, so to another question in the chat, this particular wheel strategy, part of it is buying the stock. If you're not planning on buying the stock and don't want to buy the stock, then this is not the strategy for you. You could still do a short put, do it out of the money, realizing there's always a chance you buy it, but that's not your intention. But for this particular strategy, you plan on buying the stock. Again, $180 strike, that could be more expensive. Maybe you find a $40 stock or something like that. Makes it a little bit more viable of that. So that's the wheel strategy. Let me see if there's any other questions I need to answer. And then I want to talk about a different one. Okay. And we're going to go a little bit quicker because there's a lot that we need to get through. Okay. We did the buying the stock thing. Let's see. Let's see. With earnings, okay, the earnings are in 2 weeks and the option is less than 30 days. So I don't understand the 2.5. I'm not sure what you're referring to on the 2.5 months thing. We are selling this put past earnings. We sold March 6th. So that's about less than a month away is what we sold. There's more risk, I guess you could say, because of the earnings, but you're also compensated for that risk with higher implied volatilities. In other words, higher premiums we're bringing in on that. Okay, now that's the traditional way to start a wheel strategy. Let's say you already have a stock. I'm going to go to my long stock. I've got Delta Airlines, and you're looking at Delta Airlines, and I have 100 shares of Delta Airlines, and I say, hey, I kind of like this strategy. Okay, I kind of like this strategy, but I already have the stock. Can I then start, instead of with the short put, which is the traditional way of starting it, can I start with a covered call? Yeah, we have 100 shares of Delta. I could sell a call, maybe, I don't know, up here somewhere, 77 or something like that. I don't know. And then if the stock happens to go up here, and we'll bring in the premium when we sell the call, okay? If it happens to go up there, we're going to sell our stock, but then at that point, we'll sell a put at that point, okay? We'll sell a put and bring in a premium. So yes, we can start the wheel strategy. The wheel strategy, sell a put, do a covered call, sell a put, do a covered call, bring in premiums along the way. P is supposed to be premiums. You don't have to start right here. You could start right here. And as long as the stock, generally goes up, it works pretty well. If the stock just gets in a continuous downtrend, not so much. Then you get in a problem here. So let's do this. Let's look at Delta. Now, when you're considering entering a wheel strategy for the first time by selling a call, and we own the stock, you may want to do it. You may want to try and time it to when you think the stock may be more likely to kind of be on a sideways or downward path than right when you think, let's say you thought the stock were going to go way up. Well, maybe you wait a little bit before you actually enter that trade at that point. But in this case, I'm going to say, looks like Delta may be flagging a little bit. I'm going to sell a call here. I can use essentially the same rules here. I'm going to go out about a month. Now, Delta is not going to be as liquid as NVIDIA, 2.9 million shares. Not terrible, but and that may be a bigger difference on those weekly versus monthly expirations. Let's see. Probably don't need that many. Well, we'll look at it here. Okay. Let's look here. Let's go out to that 30-ish Delta. We got 34 Delta. Ooh, look at that bid-ask spread. Now, there was a question earlier in the chat. Do I look at volume and open interest? Open interest, possibly. Probably not volume, though. Okay? The option volume. Probably not option volume. That resets every morning. Okay? If you have sufficient open interest, more importantly, I would say probably, is check out the bid-ask spread, not just necessarily of the contract you're looking at, but maybe some other contracts around it. Because if your contract has a nice tight bid-ask spread, but everything around it has a terrible bid-ask spread, then you probably don't want that anyway. So this is not one I would sell if your spread is too big. How big is too big? Look, ideally, the spread is within 5% of one another. In other words, let's see, what we're going to look at this one here. What's 5% of a $2 option? Well, about 10 cents, okay? These should be within about 10 cents of one another. That'd be nice. 10% maybe, nothing any more than 10% though, okay? If it's more than 10%, no, we're not going to look at that, okay? So here's what we did, okay? Let's check out, instead of those weekly options, let's go to the monthly options. Just check out the spread. Are they a little better? Well, they are a little better. They're not ideal. They're kind of on that borderline there of that 10% level, right? Because 10% of a 210 ask price would be 21 cents. Is this 21 cents? It's actually a little bit outside there. So I may not do this strategy today. It's borderline. This one's a little borderline there. But if it's any bigger than, if it's much bigger than 10%, definitely don't do it. This is bigger than 10%, so I'm not going to do it in this case. This is not true just for this trade, for any type of option trade you're doing, or actually any type of trade you're doing at all. If it doesn't meet your initial parameters, just learn to walk away from it. If you're a batter playing baseball, learn not to swing at certain pitches, right? This is a pitch we're not going to swing at. Okay, hoping that answers the question. So we did the wheel strategy on NVIDIA. Let me go back. Here's NVIDIA. And if you want, you could always add a little column on here, a note column, and just say wheel strategy. And you need to be a little careful because what I just did is I just added that note on the put. And so when this put goes away, that note would go away. So you could add it to the stock itself and type in wheel strategy and then just save it. So how do you do that? You can add a note column. You click on the little gear, go down to the ends. There's one that says notes. You can add it just like that. Okay? All right. There you go. And so my guideline in this webcast was 10%. So thank you. I appreciate Connie answering that question in the chat. It's not a right or wrong answer. I'm giving you guidelines we're using in this webcast. We're saying minimum 10%, ideally 5% or less is what we're doing there in this. Okay. Other people will have different guidelines we can use. Okay. Now, so here's our short verticals. We may get back to those. Long stock, we may get back to those, but I want to talk about a trade that's going south on us, okay? Because it's important. We don't win on all of them, and some of them go south, and some of them go south in a big way. And this is one that really went kind of south in a big way, and that's Meta, okay? Different type of strategy entirely, okay? So we're moving outside. We talked about wheel strategy. We're talking about other option management because, hey, this is managing an options portfolio class, and you likely have different types of trades in here. This is a diagonal spread. How do I know it's a diagonal spread? I have different expirations, well, same type calls, okay? Different expiration dates, March 6th, February 20th, different strike prices, 735, 715, different expirations, different strikes. That's a diagonal spread. Okay. What's happening on this one? Well, oh boy, it's not looking good, folks. What happened is when did we get in this trade? We got in this trade on the 30th. Okay. This is a bullish trade, right? You can look at your delta on this if you want. Positive delta. We got in this on the 30th. Here's Meta. Where's the 30th? Is that the 30th? That's the 30th. Okay. It was right after earnings. We jumped off on earnings, jumped up after earnings, and we've just given back everything on the stock that we got in after earnings. So we were bullish, and this just turned into a really bad bearish trade. Furthermore, we're only 9 days to go to expiration on this. And on a lot of these trades, look, once we're less than 10 days to go to expiration, then we're going to look to get out of this trade. Now, could we hold on a little bit? We could hold on a little bit more. If we were bullish, we can consider rolling this. If we're bullish, at this point, I'm not sure I'm really bullish on this anymore. In fact, we drop below, this is where technical analysis may come in. We drop below a potential resistance level. I think we're just going to take our lumps here and get out. As much as it pains me to take that big a loss, I'm going to do my best to try and prevent more of a loss on it. So there we go. Because there's still a fair amount more we could lose on it, right? We've lost 72%, but it can get worse. Look, this trade, the mark on this, about $450 could go to zero. We could lose $450 more on that. On this, there's not much more we can get out of the short call in that case. So I'm just going to get out of it. Okay. You can highlight both of these, right click on them, create a closing order, and get out of the diagonal. You can do it that way. You can get out of one leg at a time too. Doesn't matter. You can get out of either way. If you do get out of one leg at a time, often you'll get out of the short leg first. And the reason is, if I get out of the long leg first, that leaves me, albeit maybe for a short period of time, with a naked call. You may not be approved for naked calls in your portfolio. So you may need, if you're going to get out one leg at a time, you may need to get out of just that short leg here. So we can do that, confirm and send that, and then I'm left with this, but I'm going to get rid of this long call here. And I'm going to get out of this one as well. That's what we call taking our lumps, taking our losses, trying to cut our losses down. There we go. Okay, let's look at something that's a little more pleasant. It certainly doesn't make up. I looked at this before our webcast. This was actually up substantially about an hour ago. Well, no longer. This one is down too. This is a calendar spread. Now, we're only down $10, so I'm not going to worry too much about that. We've got 9 days to go to expiration. And generally, when we're under 10 days, we're going to get out. The exception of that, I would say, is if we just got in a few days ago, we may give it a little more time to run. We got in this on January 13, almost a month ago. So I think we're going to get rid of this one. Or we could look to roll if we're more still neutral on this. This is a calendar spread, okay? This is a calendar spread. 490 strike, 490 strike. Different expirations. Unlike the diagonal where we had different expirations, this is just purely a neutral trade. We want the stock to be around 490, okay? Well, do we think there's a chance is that kind of the realm it's going to be in? Got to get the right stock in. BRK.B. Yeah, I mean, if you're kind of neutralish, we may let this run a little bit, or we may roll this out in that case. Why do I say roll it out instead of just let it run? Because we're only at 9 days to go to expiration. But I can roll that 490 February 20th out to a 490. Let's look at it here right now. So this is what we have right now. 490 February 20th. I'm going to go out to March 6th. If I sold this 490 March 6th, let's just see what kind of credit we would get on this. I'm going to just right click on this particular contract. I'm going to create a rolling order. Now, rolling orders aren't going to save you on commissions. You still got the two different contracts. You're getting out of the February 20th. You're going to the March 6th. I'm going to keep it at 490. That's going to bring in about a $300 credit or so to our account right there. Now, FibZone says, can we place an iron condor? You can do iron condors as well. This is a neutral trade. Iron condors are neutral trades, okay? So I'm not placing them on other trades right now because this is what we're going to go through a management of our existing trades. We're managing our existing portfolio. But, you know, this calendar, for those of you who aren't familiar with calendars, they're neutral trades that have some similarities to iron condors, some differences as well. But that would roll this out. Notice when I do this roll and it gives me that credit is assuming a mid price. Realistically, we're probably not going to get filled in a mid price. Maybe in paper money, real life, probably not. I'm probably going to have to accept a little less of a credit there. But I'm going to confirm and send. I'm going to roll this and bring in that credit there on that. Okay. So there we go. That we're going to let that cook a little bit. Let that go a little bit longer for us. And by the way, when you're looking at these trades, one thing you may keep an eye on, I got a lot of columns here, is a theta column. Is your trade positive theta or negative theta? Well, it's positive theta. So time decay is helping us out. That's good. We just want the stock to stay neutral. Now, when we rolled this out, we got rid of the older contract. We got in this new contract. Well, we had a nice little positive gain on the older contract. So we reset this one back to 0. And so now instead of roughly break even on the trade, it's going to show that we're losing a lot. But if you take in the totality of the trade of the contract that we closed out already, then all in all, we're not doing that badly on Berkshire, but we're going to let that run. We're going to try and keep that theta. But remember, you're only going to do this trade if you're still neutral on it. If you weren't still neutral on it, then we would just get out of the whole shebang. Okay? I'm hoping that is making sense there, everybody. Okay. All right. We are just about out of time. I'm not going to manage each of these, but let me just kind of mention this as we go to our long options. Some of these, you have a day, you can add a days column in there. And you can look to see how many days you have left on the trade. Caterpillar's been doing great. Probably move the stop up, okay, on this. I may do that, I may do that next week, but probably move the stop up on that because that one's been doing well. CMG, it's a long call. I've only got 9 days to go till expiration on that, okay? We're probably just going to get out of that trade. That one, unfortunately, is going to be a little bit of a loss there on that one. If we get out, I'll probably get out of that after this, right after this session is over. Capital One, it's a long put. We're doing quite well. The stock's been going down. We have a stop, probably want to reset this or look at the stop and consider tightening that stop up here on this because that's doing fairly well. Coke, only 9 days to go to expiration. Probably going to take we got a nice gain on that one. I'm probably just going to get out. We only got 9 days to go till expiration. That's been a nice trade for us. So those trades that we have, we're under 10 days to go. We're just going to look to get out of those. So that's most of our trades. We're going to look to get out when we get under that 10-day mark. One exception to that is the one we started this webcast with, is this NVIDIA short put, because we don't mind buying the stock here for NVIDIA. That was our wheel strategy. That's what we covered today, everybody. Wheel strategy, adding in short puts, then turning it in and selling cover calls on the stock that we ultimately may buy, and repeating the process. We'll follow this up in future weeks as well. But I want to thank you for joining me, each of you. We're on each week at this time. Make sure you subscribe to that Trader Talks channel on YouTube. If you look at your screen, there should be a subscribe button if you haven't already subscribed. I want to thank Connie in the chat for answering those questions. Remember, there is a survey link in the chat. Coming up next, we have trading price patterns. And everybody, I appreciate you. We will see you all same time next week. Bye-bye, everybody.